A very good morning, friends. So I hope you're all doing well. And most importantly, I guess you revised what we covered yesterday on India's 12. Well, we had a little background discussion yesterday on India's 12. Number one, in terms of why there is a need for India's 12. Then I took you to the next aspect and I introduced you to a five-step model where we said that this is not given in the standard, but this is something which we are going to follow for the purpose of easily managing the application of India's 12. And I give you the simple five-step model that your first step is in terms of calculating the carrying amount of the asset or liability. The reason is simple. I told you that India's 12 is based on what you call a balance sheet approach. And considering that it is based on a balance sheet approach, so we would consider first of all step number one, calculate the carrying amount of the asset and liability. There is no role of India's 12 as far as step number one is concerned, because the calculation of the carrying amount is purely an exercise which is based on the application of the relevant standard. So look at the asset or liability, see which standard is applicable to the concerned asset or liability, and accordingly, you can calculate the carrying amount. Step one has got no role in terms of India's 12. The second and the most crucial step in terms of India's 12 is calculating the tax base. And we're still working on step number two, where I give you a basic introduction. I'll be working a little more on the tax base of the asset today with you. So the tax base of the asset and liability needs to be computed. Step three is a mathematical exercise. You compare the carrying amount in step one versus the tax base in step two, and you get a temporary difference, which is classified as taxable or deductible. I gave you a little flair, a very basic flair of what exactly is a taxable temporary difference. We're going to go do it today again. Then step number four is the taxable or deductible differences computed in step three needs to be multiplied with a tax rate. And this tax rate is what we're going to determine in step number four. Though we all know, of course, you've done your IGAP AS22 as well. So when we consider a tax rate, we consider what is called a substantially enacted tax rate. But we're going to talk of it once we come to step four. And then finally, step number five is the recognition that where do you recognize the deferred tax? Income and expenses in Ind AS in Schedule 3 are taken at three places. Either it enters in the P&L, or it enters in the OCI, or it enters directly in terms of SOKI. So we'll have to very carefully, once we come to the full-fledged questions with you, we're going to see how we are going to put it either in the P&L or in the OCI, or it's going to be taken directly in equity, that is SOKI. Okay, so I think let's start the journey and let's concentrate on step number two. And I guess, of course, my throat is a little better today, but I think I'm still not wanting to take much chances. So we'll definitely continue this class for at least 1.5 hours. If I guess my energy levels permit me, we might extend it, but otherwise we're going to make up this on Sunday. We're going to have a complete 3 hours class on Sunday. So thanks for bearing with me. So let's start back the journey. Okay, so let me also see if there are any questions which are there so far. Yes, I think Viraj tells me wonderful things. So good morning. And I've revised the yesterday class. That's great. I hope everybody's done the same. Okay, now let's start the journey. And let me just remind you the concept of a tax base of an asset. Now get this very clear, because if the chain is very clear, nothing stops you. So I'm just going to make some notes as well. So we're working on the step number two. In terms of step number two, I'm concentrating on the tax base for an asset. We'll talk of liability very shortly. So we're looking at a tax base of an asset. Now, every time you calculate a tax base of an asset, you need to put across a question to yourself. when future economic benefits will arise. Underline the word future economic benefits will arise. Every asset in the balance sheet 100% gives you economic benefits. It may be in the form of collection of that money. It may be in the form of sale of goods and services, whatever. But every asset in the balance sheet is undoubtedly going to give you an economic benefit. So you don't need to ask yourself that economic benefits will arise or not. This is something which is implied. Economic benefits will definitely arise. So we need to put across when future economic benefits will arise. Will income tax authorities come and tax it? Are they going to come and tax it? That's the question you need to put yourself. So when the benefits will come, will the income tax authorities come or they will not come? So there are two possibilities. Either we say, yes, they will come and they will tax you, or you say, no, they will not come and they will not tax you. Now, if you say that they're not going to come, if you say that they're not going to come, then in this particular case, let me remind you, there are three reasons. There could be three reasons that they will not come. So you need to keep a track of these three reasons. Number one, it is already taxed. The economic benefits have already been taxed, and therefore they are not going to come. The second reason could be in terms of that it is exempt from tax. The second reason could be that it is exempt from tax. The Income Tax Act tells me that this income is not taxable, so it is exempt from tax. Or the third one could be that it has got no tax consequences. Or it can be that it has got no tax consequences. When I say no tax consequences, it means it is in the nature of, let's say, a capital receipt. It doesn't trigger its capital income. It's not a revenue income, so no tax consequences would arise. So trust me, these are the only, and this is a comprehensive list which I'm giving you, an exhaustive list where you will get an answer no. Carefully look at the situation and just put across a question that when the benefits will come, will the income tax authorities come or not? So answer is a yes or no. The no is only on account of these three reasons. If you say no, your tax base and the carrying amount is equal. And the logic is simple. If the tax authorities are not going to come in the future, there is no future implications. If there are no future implications, naturally, there is no future deferred tax. Because deferred tax is what we know that it is something which relates to the future. So if they're not going to come in the future, then there are no future consequences and no deferred tax implications. But if you say yes, you will immediately ask yourself, you will tell the income tax authority, okay, these benefits are taxable, but what is the deduction you will give me against these benefits? So my tax base is the question which I'm going to put to the tax authorities. I'm going to say, okay, tell me what is the future deduction under Income Tax Act. What is the future deduction under the Income Tax Act against, the word is very clear, against the taxable economic benefits, against the taxable future economic benefits. So I'm going to put across a question that against these benefits, what is the deduction you will give me under the Income Tax Act? The future deduction becomes the tax base. So this is my CRIPS note to you on the concept of tax base of an asset. We're yet to talk in terms of liability. I hope the chain is very, very clear. I guess let's get your inputs. I guess my concept is 100% clear. I don't want even 99.99%. I'm looking for 100% clarity in terms of things. The examples will further give you a good level of clarity. But I guess the change should be very clear. When the benefits will arise, will the tax authorities come? If you said no, the three reasons should be clear. And then the tax base and carrying amount is same. And if you say yes, then you need to identify the deduction. The tax base represents the deduction. Now, at this stage, let me also put one thing for a good level of clarity at this stage. Technically speaking, what does a carrying amount means? The future economic benefits. And technically speaking, what does a tax base means? It means a future deduction. So I can call the future economic benefits, if they are taxable, as good as future taxable income. So you need to keep one thing very clear in the mind. This is very, very important to keep in mind. Then when I'm using the word carrying amount, the word carrying amount is indicative future income, taxable income. I'm not looking at this situation. The moment you know that the tax authorities will come, the carrying amount represents the future taxable income. Carrying amount is nothing, but it is synonymous. A carrying amount is synonymous with the concept that it is a future taxable income. And a tax base is synonymous with what? Deduction against that income. I guess I am pretty clear with this concept. Okay, that's great, Koshki. Wonderful indeed. Good morning, Shriram. Good morning, Namrata. Good morning to all of you once again. Okay, now with this particular concept in hand, I'm going to make a walkthrough of certain examples which are given in the standard. They're part of the study material as well. But these 5 beautiful examples is going to give us the concept very clear. So let me just come back. We saw the definition of a tax base of an asset yesterday as well. So we're just going to make a walkthrough so that our understanding is completely in tandem with the definition given in the standard as well. It says tax base of an asset is the amount that will be deductible. So when I say will be deductible, it means what? Future deduction for tax. So what does the tax base represent? Future deduction under Income Tax Act. Get the words very clear. Future deduction under the Income Tax Act against any taxable economic benefits. When the asset, the carrying amount of the asset will give economic benefits and they are taxable, you will say the tax base is a future deduction. Then he says if those economic benefits are not taxable, the tax base is equal to the carrying amount. I just simply, simplified the definition to you in the form of a question. You need to very carefully think when the benefits will come, the income tax authorities will come or not. If no, end of the story. If you say when the benefits will come and the income tax authorities will come, you need to know the income tax provisions. What is the deduction allowed under the Income Tax Act? Let's begin the journey. Now, I'm going to take examples. There are 5 examples given in the standard. I'm going to walk through all those examples very carefully with the chain of thought. It says a machine is costing 100 and for tax purposes, depreciation of 30 already being deducted. You've already claimed a depreciation of 30. So I think if I'm just looking at the question, that what is the future deduction? 70. But before that, I need to put across a question that whether the income tax authorities will come or not. And then it says the remaining cost will be deductible in the future periods. Let's go further. Now, we give more information. I'm just taking it further to the examples. Then it says revenue generated by using the machine is taxable. Any gain on disposal of the machine will be taxable. He's very clearly given you the logic as well. The machine will give you economic benefits by way of sale of goods and service, by way of, you can say, sale of the machine. Now what I'm going to do, I'm going to give you a chart so that once you revise this standard in the future, you can do it in 2 minutes. because this chart is going to be very important. So I'm just going to add another chart to you at this stage, and this is going to be a complete understanding of the tax base. So let's make a wonderful chart on the tax base of an asset. So I'm looking at the same items. I'm looking at a column particulars. I'm looking at future economic benefits will arise in what form. This is only for your logical understanding. And will it be taxable? Whether the income tax authorities will come or they will not come. So will it be taxable? And then I'm looking at what is my tax base, which I know is supposed to be a future deduction. Now let's get the chain very clear. The first item is a PPE. How does a PPE give me economic benefits? The form in which economic benefits arise is sale of goods and service. And it is also the sale of a PPE at the end of its useful life. So these benefits, when these benefits will arise in the future, will the income tax authorities come and tax you? Yes. So I will say, okay, what is my tax base? I'm going to say that in reference to the asset, you need to give me a deduction. So the deduction is what? It is the future deduction. So in my example, can I say out of 100, 30 is already claimed as a deduction. So what is the future deduction going to be? The future deduction is 70. I hope the chain is very clear. So first, put yourself a question in the mind. The benefit arises in what form? And when these benefits will arise, will it be taxable or not? If you say yes, then see what is the deduction. The income tax will give you with reference to the asset. So they will give you a deduction for the future depreciations to come. So that is the tax base. Okay, let's go ahead. Let's now look at another example with you. So I'm looking at the second example now. The second example. So in terms of the second example I am given, there is an interest receivable which has got a carrying amount 100. The related interest revenue will be taxed on a cash basis. It says the interest in the balance sheet is going to be taxed when you collect. Cash basis. We'll take an accrual basis also for understanding. Let's go back. So we've got a second example, and that second example is pertaining to the concept of interest receivable. Now I need to understand that the economic benefits will arise in which form? Collection of the amount. Interest receivable is going to be collected. So we can say that interest receivable is you will collect the amount in future. Now I'm going to take two situations. Let's say the tax arises on a cash basis, and let's say the tax arises on an accrual basis. And let us see in both the situations whether the income tax authorities will come or not. So I'll say, okay, when you collect the money, will the income tax authorities come? Yes, because they never taxed you on accrual basis. They never taxed you on accrual basis. So when you go to collect the money, they will come. So yes, on a cash basis, they will come. If they will come, what is my tax base? It is a future deduction. Will I be able to claim a deduction under the Income Tax Act for the interest revenue? No. The income tax provisions do not allow you any kind of deduction in terms of the interest earned. The gross amount is taxable. So you get no deduction. Since no deduction is allowed, we can say it is zero. Remember, the tax base represents the deduction allowed under the Income Tax Act with reference to the given item. The interest is going to be taxable on a gross basis, so you're not going to get any deduction for the same. I hope the chain is going very, very clear. Okay, so that's wonderful. And Viraj, you said, so yesterday I've not seen Index 103 in the list. May 23 examinations of compulsory questions, 15 marks, consolidation of balance sheet. Yes, in May 23 examination, you didn't see Index 103. The very first question was Index 103. The very first question in the exams in May 23 was a blend of 103 basically. I would not say 110, it was 103. 110 was missing. 110 was missing. There was a very small question, I think a 5-marker question on 110. So you could expect, maybe a bigger question this time. But it was there. 110 was almost, I think, 5 marks. And 103, of course, was the first question, the main question itself. Okay. Now come to the chain interest receivable taxed on an accrual basis. Now see, when you go to collect the money and the income tax people are saying we'll tax it on accrual basis. So when you go to collect, will they again come and tax? No. Why? They've already taxed you when you accrued the income. So in this case, the answer is no. They will not come because it is already taxed. Because it is already taxed. So the income tax authorities have applied an accrual basis. So when the income arose, they came and taxed you. Now, a very important thing before once I finish this, the tax base and the carrying amount in this case is equal. Now, there is one very important thing which I want you to understand and appreciate, because this is going to help you in the understanding of the industrial further. Okay, now just have a look at this very carefully. Just have a look at this very carefully. This is accounting books and this is taxation books. For understanding perspective, I'm giving you a thought based on an income statement approach, but don't be guided by that, we can't use this. You can use it for convenience at times. But what is the thought? Let's say if there is an income, let's say if there is an income in a particular year and that income is taken in accounts and is taken in tax in the same year. If there is an income, which is recorded in both the books of accounts in the same year itself, or even if there is an expense, which is recorded in both the books in the same year, do you think there is any difference which is arising? No. So in this particular case, since there will be no difference, you can definitely say that using a income statement approach, there will be no deferred tax. There will be no deferred tax implications. Though I'm giving you an income statement, but at the back of the mind, if you given, for example, interest receivable. Now imagine if I'm looking at, for example, an interest. You recorded this in accounting on a cash, on an accrual basis. But you refuse to record it in the same year for tax. Because the tax says that it is taxable on a cash basis. So you took it on a cash basis in a different year. So if you took this in a different year, if you took it in a different year in this particular case, you can easily think that yes, there is a difference arising in year one. You need to visualize also the income statement approach, just to get a clarity of thought that if there is something which is taken in accounting this year, but not in tax this year, it is taken, but is taken in a different year altogether, then this difference will definitely give rise to deferred tax. So this is another thing which you can keep in mind. So for example, as I said, if you've taken an income or an expense in both the books same year, no deferred tax implications would arise. But if you've taken that income and expense in 2 different years, then a deferred tax implications would arise. And there is a third situation also, which I will discuss later. Right now, we're looking at 2 situations. If you've taken them in the incomes in both same year, no implications. Different years, yes, the implication rise. This is only for your conceptual understanding. Okay, now let's have a look at another third example. Let's take you to example 3. Now I'm going to the example number 3 and see what it says. There is a trade receivable with a carrying amount 100. The related revenue has already been included in the taxable profit. So when you made a credit sale, the income tax authorities came and they taxed the benefit. Let's go back. So I'm looking at the third example, that is on a trade receivable. So let's have a look on the third example, that is trade receivable. So what is the form in which economic benefits will arise? You will collect the money. So you will collect the money. So the collection of the, you can say, amount will take place. Will the income tax authorities come to you when the collection takes place? No. Because when you made a credit sale, they already came to you and they already taxed you. So they are not going to come. The same logic, it is already being taxed. If it is already being taxed, then I very clearly know that the tax base and the carrying amount is same. So which means what? If you apply an income statement approach at the back of the mind for understanding, you must have taken the credit sales in accounts. You must have taken the credit sales in tax in the same year. Just look at the income statement approach that, you would have taken the related revenue which created an asset. You would have taken the related revenue in terms of accounts and tax in the same year. Therefore, future implications cannot arise. Okay, let's take it further. So that was example number 3. Now let's have a look at the example number 4. And in the example number 4, we are given dividend receivable. I think I gave you that example yesterday as well. Dividend receivable from a subsidiary is got a carrying amount of 100. The dividends are not taxable. They're not taxable. So when the dividends will be collected, will the income tax authorities come to you? No. Why? It is exempt from tax. Let's go back. The chart which I'm making right now at this stage, this is going to be extremely helpful to you. Anytime you forget the concept of a tax base, just look at this flow of thoughts, you'll get it straight. So let's put the fourth example to you, which is on account of the dividend receivable. So how would the economic benefits arise? You will collect the dividends. Will the income tax authorities come to you? No, they will not come to you. But this time the reason is that it is exempt. Can you see the chain of thought? In this example, they did not come because it is already taxed. In this example, they will not come because it is exempt. You'll see the sequence of the reasoning. So in this particular case, again, the tax base and the carrying amount is same. So intentionally, I've given you this column as well, so that you're also able to understand that the economic benefit arises in what form. Because PPE, intangibles, investment property, generally the collections will not arise. Investment property, rental income will arise. Sale of investment property will arise. PPE intangibles, you're going to produce goods and services, so revenue of goods will arise. Ultimate sale of the asset will arise. For other assets, generally, you're going to make collections. You're going to make collections, and when you're going to make collections, in those particular case, the collection is the benefits. And you need to visualize, will the tax authorities come when the benefit arises or not? And accordingly, you decide a tax base. Okay, let's go to the last example. So there is another last example which is given, and that is with regard to a loan receivable. Simple. Now, in this particular case, on the loan receivable, I am given a loan receivable is got a carrying amount of 100. The repayment of the loan, there are no tax consequences. So if you've given a loan to someone, I'm looking at the principal amount of the loan. So when you go to collect the principal amount, income tax authorities will not come because that amount is not taxable. Reason, it's a capital inflow. It is a collection of the money which you give to someone. It's not income. The interest which you earn is taxable. The principal repayments are not taxable. So let's go back to the chart. So let me fit another fifth example as well. Let me put it out here on the top. So we can say in terms of number 5, we've got a loan receivable. What is the form in which the benefits will arrive? You will collect the money. Will the income tax authorities come? No. Why would they not come? The reason is it has got no tax consequences. It has got no tax consequences, so the tax base and the carrying amount is same. Let me now show you a very interesting sequence in these 5 examples, which is going to build up your concept. Let's have a look out here very carefully. In the first case, the benefits was arising and the tax people were coming and they were giving you a deduction. In the second example, the benefits were coming, the tax authorities were coming, but they were not giving you a deduction. Look at the sequence of the flow. In the first example, the tax authorities were coming, they gave you deduction consequences. The 5 example gives you umpteen clarity of thought. But I'm going to test you very shortly after I'm done with the tax base or the liability. But I believe the thoughts should be 100% clear at this stage. You should be able to visualize for any asset in the balance sheet that when the benefits will come, the income tax authorities will come or not. If not, tax base carrying amount same. 3 reasons of not coming. And if they will come, we need to know deduction under Income Tax Act with reference to the concerned asset. Right. Let me see that any questions coming in so far. Okay. I guess, Shriram, you had a question. So, in case of loan receipts, the payer will deduct a TDS at a little repayment of installment to us on the interest portion. Yes, on the interest, not on the principal. From the income tax point of view, the interest is something, he's going to deduct a TDS, but principal has to be paid directly. So that's right. So principal, there will be no tax consequences in any case. Okay, that's great. I guess now we are ready to go to the next concept, and that is tax base of a liability. You just need an account or the tax base of an asset, and now start thinking liability. So we are switching over new concept, that is a tax base of a liability. Now let's have a look at the definition very carefully, because this is going to give us a lot of beautiful concept. Just watch this carefully. Let me just clear this. Now I'm going to the next concept with you, and this is a tax base of a liability. So please hear this very carefully, because I'm going to give you a new chain of thought. I'm going to read the definition to you, and we're going to build a concept the way we've done for the asset itself. Okay, but before that, I think it's the right time to do one thing. Before I go to the tax base of a liability, I am going to first of all give you another input related to step number 3 to make it more clear. To make it more clear, let me just go out and give you another thoughts at this stage. It's the right time. I just love this standard. Any technical standard, I just love them. More technicalities means you've got more scope of simplifying things in life. Simplified, you can't oversimplify. But more the complex standard, it's an interesting way, you could crack down things in a very simplified manner. Okay. Now, I'm just going to build up a concept. So, in nutshell, based on our discussion so far, if I'm looking at an asset, as I said earlier, the carrying amount is synonymous with future economic benefits. I'm not looking at a situation where the future economic benefits are not taxable. I'm considering that if they are taxable, you can say a carrying amount always represents a future income, assuming it is taxable. Assuming it is taxable. So, in simple words, we need to appreciate that a carrying amount is as good as a future economic benefits, is as good as a future income for the purposes of this standard. Though this is true for any standard. This is true for any standard, but typically You need to keep this chain that when I say a carrying amount of the asset, your mind should immediately tell you, okay, you're looking at a future taxable income. Great. Now, when I say a tax base for the purpose of this standard, it basically represents, you can say, a future deduction. Future deduction against this income. It is a future deduction against this income under Income Tax Act. Under the Income Tax Act. Now get the logic. So when you're looking at a tax base, a lot of people have got a confusion in life. They start thinking that tax base represents the value according to tax. No, it's not value according to tax. The tax base is a term, but it represents deduction. So when you're looking at the income tax perspective, that is the tax base, your thought is, what is the deduction they will give me against the taxable income? So now let's have a look at the chain with a small little figure to get things very clear. If the future economic benefits will arise to the extent of 1,000, this is future income. You will get a deduction against the income equal to 600. So what is this 400? It's a net income. It is a net income, that is a taxable difference. This is a difference which is temporary in nature, because you might have got, let's say, lesser depreciation in accounts, but more depreciation in tax. So today you've taken less depreciation in accounts, more depreciation in tax. Maybe in the future, of course, things will take a reverse direction. So the difference which is arising today is purely what we call a temporary difference. It's a temporary difference, that's TD. That's what my step 3 is. This is my step 1. This is my step 2. And this is my step 3, that you're getting a temporary difference. And now you need to classify, is it taxable or not? This is what income will arise. This is deduction which I will claim. So this is the net income which will arise. So this is called taxable temporary difference. So which means that if the net income will arise, you will pay tax. When you say you will pay tax, so what does this mean? That you are now going to give rise to what? A deferred tax liability. Your step number 4 would be that the taxable temporary differences or the deductible temporary differences got to be multiplied with a tax rate. So let's say the tax rate is 40%. You get a DTL to the extent of 40% of this. That is step 4. Now look at the other way around. Let's look at another example with the other way around. Now let's consider in this case that the economic benefits, let's say the economic benefit is 600. The deduction against this is going to be 1,000. You will earn 600. You will claim a deduction against that income more than that. So there will be a difference which is net deductible. So this 400 becomes what we call deductible difference. So when the carrying amount of the asset is more, it is taxable. I'm talking only for asset. I'm not talking for a liability right now. Don't apply this concept to liability. In terms of asset, we need to understand that if the carrying amount is more than the tax base, it's a taxable difference, and the other way around, it is deductible. So this deductible differences will lead to a DTA, and that is 160 if I take a tax rate 40%. I hope the chain is very clear. I thought it's the right time to give you an application of the 4 steps right away. Get the carrying amount, get the tax base, decide the difference is taxable or deductible in nature. If the carrying amount is more, net taxable difference. If it is less, deductible differences. Taxable would lead to DTL always, and deductible will lead to a DTA always. Right, friends. Let me see if there are any questions coming so far at your mind Okay, I think nothing so far. So I think it seems that we are going very comfortable indeed. Okay, now let me go back to the definition of a liability with you. I'm going to come back now on the definition of a liability. So let's have a look on the definition of a liability, which is given this time. The tax base of a liability is the carrying amount less any amount that will be deductible for tax purposes in respect of that liability in the future periods. Now, friends, please hear me very carefully, because this is again, a point where people falter a lot. You need to understand that there are two kinds of liability in the balance sheet. One is a liability which you're going to settle in cash, and one is a liability which may not be settled in cash, but you are going to settle by providing goods and service. So there are two definitions of a tax base of a liability, which is technically given in the standard. If you look at the definition, it gives you that in case of a revenue which is received in advance, he's given you two definitions. We're looking at liabilities, which are going to be settled in cash. We're going to look at liabilities which will be discharged by way of goods and service. So accordingly, you'll have to select which definition is to be applied. We will look at the second definition later. It says the tax base of the liability, let me mathematically note it down. The tax base of the liability is the carrying amount less any amount that will be deductible, that is a future deduction. Asset, the tax base is future deduction. But liability, the tax base is a carrying amount minus future deduction. This triggers my mind. Imagine if the future deduction is zero. Imagine if the future deduction is zero, then mathematically the tax base and the carrying amount is going to be equal. I think that's very simple to understand, that if the future deduction is not there, that means the tax base and the carrying amount is same. That gives rise to a very important question in mind. For a liability, you are going to put across a question: when you're going to pay the liability in the future, will the income tax authority give you a deduction? So what is the chain? जब आप liability pay करेंगे, क्या income tax वाले आपको deduction देंगे? If the answer is yes or no. If the answer is yes, they will give you a deduction. This is the tax base, carrying amount minus future deduction. If the answer is no, they will not give you a deduction. If they will not give you a deduction, there is no future consequence. If there is no future consequence, then there is no deferred tax implications either. Get the chain very clear. It says the tax base is the carrying amount less amount which will be deductible for tax deduction available under the Income Tax Act when the future, like in the future periods. So the chain is going to be very clear that when you are going to pay the liability, will the Income Tax Authority give you a deduction under the Income Tax Act, and then proceed further. Let's take an example. Let's take an example to understand this bit. So let's create another kind of a chart. First, we're going to create some notes on this, and then I'm going to take some examples with you. So let's, I think, create a chain. Now I'm looking at the step number 2, the tax base of a liability. It's a part of my step 2 main step, where I'm looking at the tax base of a liability to understand. Okay. So let me just first give you a chain of thought how you are going to proceed in terms of putting questions. I'm going to put across a question number 1. When the liability is paid, when the liability is paid, underline the word paid. There is another definition which is going to be discharged by way of goods and service. We'll make mention later. So when the liability is paid, will income tax authorities will income tax authorities give us a future deduction? Will they give us a future deduction? Underline the word future deduction. So the chain is, when you are going to pay a liability, will the income tax give you a deduction? So the answer is either a yes or the answer is a no. I think if you're understanding the concept very well, let me ask a question to you and let's see how do you answer that. So when I say that the income tax authority will not give you a deduction, to your logical mind, how many reasons can there be? So when I say that yes, I will make a payment, but the income tax authority will not give you a deduction, what do you think? How could be, how many reasons could there be that I will make a payment, but they will not give me a deduction? Let's see. If you can answer this, then I think your fundas are going very, very good. Okay, I think Shriram, you said, sir, questions can be expected from this index for how many marks? Well, it could range. The past examination questions have been like 6 to 8 marks on an average. So you could get that weightage. In any case, you'll see the application of this particular standard, even in terms of index 103. Okay, so my question is that when you say that you're going to make a payment and the income tax authority will not give you a deduction, what do you think could be the number of reasons that they will not give you a deduction? If you can answer this, then I think your concepts are going super duper. So let's see if, whatever time you spent on the standard is giving you the thought processes. The income tax authority says we will not give you a deduction. So what are the number of reasons that they will not give you a deduction? Okay, so wonderful. I think that's very good, Shriram. Number 1, already allowed. I like it. Number 2, not eligible for deduction. I like it. And number 3, that no consequences. It's a capital loan. It's a loan, principal amount of the loan repaid. And Janvi tells me income in relation to expense is exempt if such expense is already allowed as an expenditure. Good. So here again, we can make an appreciation that if it is not allowed as a deduction, there are comprehensive, exhaustive list of 3 reasons only. There are going to be 3 reasons only with reference to this. And Amrita said, when tax is not deducted, yes. So we can say either it was already allowed as a deduction, already allowed as a deduction. So you were already given a deduction in the past. A double deduction would not be allowed, right? The second is that it is not allowed as a deduction. It is basically prohibited. The Income Tax Act prohibits any kind of deduction. You make a payment of this sort. Like, for example, if you pay penalty, the tax authorities will not allow this as a deduction. The penalties are disallowed. So this is a disallowed expenditure. This is already allowed, and it can be a case when there is no tax consequences. A same chain which I gave you for asset. A same chain which I gave you for asset, that's right, a capital repayment, that's right, Koshki, wonderful indeed, super. So we can say when the liability is paid, will the tax authority give you a deduction? If they say no, they will not give you a deduction. These are the 3 possible reasons why a deduction would not be allowed. In this particular case, the tax base is equal to the carrying amount, no deferred tax. No future implications, no deferred tax. And if you say a yes, the tax base is the carrying amount minus the future deduction, which is of course the future deduction under Income Tax Act. So what is the future deduction under the Income Tax Act? So this is the concerned minus future deduction. Let's do one thing now. Let's make same 5 examples with you again, given in the standard. We're going to make a similar kind of chart, and trust me, that's going to do wonders. Let's go back and let's have a look at now a few examples. I'm here to cover the second definition. I'll come to the second definition. So I'll take first 4 examples with you. Then we'll come to the second definition where the liability is not paid, but it is discharged by way of goods and service. So let's have a look at the example. It says current liability includes accrued expense with a carrying amount 100. The related expense will be deductible on cash basis. When you will pay the accrued expense, will the income tax authority give you a deduction? Yes, because it is being allowed on a cash basis under the Tax Act. So let's do one thing. Let's simultaneously make a chart to you. So let's consider another chart at this stage for a tax base of a liability. So let's make this chart. So I'm going to take a column for particulars, and I'm going to consider when payment is made. When payment is made. So we'll just say when the payment is made. So I just see, yes, the payment is made, because every liability payment may not be made. Tax authorities will give deduction. Tax authorities will give deduction, yes or no, and we're going to get the tax base, which is the carrying amount minus the future deduction in general. Now let's consider the first example, and that is accrued expense. So are you going to make a payment? Let's put it when the payment is made. Are you going to make a payment? Yes, I will make a payment. It is important to identify that what liability are you talking of? Something which will be settled in cash, or something which is going to be settled by way of goods and service. So when I say that the payment is made, I'm indirectly saying that you're going to settle by cash. So we are considering that you're going to settle by the mode of payment, which is cash. The mode of payment of settlement is cash. Yes, I will settle in cash. Now there are two possibilities. The income tax authority follows a cash basis, or the income tax authority also allowed an accrual basis. Now let me put across a question. When you will make a payment, will they give you a deduction? If it is on a cash basis, yes. So will the income tax authority give you a deduction? Yes. If they give you a deduction, now what is the tax base? It is the carrying amount 100 minus the deduction entire 100. Whatever you pay would be allowed. I'm going with the presumption that whatever you pay, that would be allowed. If that be the case, the tax base becomes 0. The tax base in this case becomes 0. Let's look at the other chain of thought. And here we're looking at, if they say we will allow it on accrual basis, since they allowed on an accrual basis, when you're going to make a payment, will they give you a deduction? No. Reason? Already allowed. Reason? It is already allowed. They already gave you a deduction. Because when the expense was accrued, they gave you a deduction at that time. So when you're going to make a payment, they will not give you a double deduction. So there will be no deduction if it is already allowed. So in this case, the tax base and the carrying amount is going to be equal. There is no. And just think logically. If you have taken the expense in accounts and tax in the same year, no differences can arise. The carrying amount and tax base is same. If it was allowed in accounts in 1 year, but it's going to be allowed in tax in another year, a difference will arise. The carrying amount and tax base is same. Anytime you're stuck up in terms of a balance sheet approach, what is going to be a tax base? Just think that with reference to this item, using an income statement approach, just start thinking that was it taken in both the books in the same year? Then carrying amount and tax base will be equal. If they're taken in the two books of accounts in 2 different years, the tax base and carrying amount is undoubtedly going to be different. This is only for your help. that in the background, you could start looking at an income statement approach, right? I hope I am going absolutely comfortable. Okay, so let me see if there are any questions coming so far in between. Okay, Shriram, you said, so what is meant by no tax consequences? Like, for example, if you make a principal loan repayment, so there is a principal loan repayment, it is what? When you're going to make a principal repayment, tax authorities can't come and tell you that you take a deduction. So it is the interest on a loan which is a deductible item, but the principal repayment of a loan to someone is no tax consequence, right? Okay, so this is one example. Let me just go back. Let's have a look at another example, not the second one of this stage, that is applicable to the second definition. I'm just going to come to another three examples which are given in the standard. Let's have a look at the other three examples. Now, wonderful. Just have a look at these examples. You see the chain very clear. I'm pretty sure now you will see that in all these three examples, you are going to see one thing common. The first example I gave you, payment की deduction मिलेगी. अब कौन से आएंगे? Payment की deduction नहीं मिलेगी. Because it is already allowed. Because it is prohibited. Because it has got no tax consequences. Look at the chain. Current liability includes accrued expense with a carrying amount 100. The related expense is already being deducted. जब आप पेमेंट करेंगे क्या आपको डिडक्शन मिलेगी? When you going to make a payment, are you going to get a deduction at that time? The answer is no. So tax base and the carrying amount is same. Deduction is not allowed. Reason already allowed. Current liability includes accrued fines and penalties with a carrying amount 100. Fines and penalties are not deductible for tax. Prohibition. When you will make a payment of fines and penalty, income tax authority will not give you a deduction. Why? Prohibited. The tax base and the carrying amount is same. Here it was already allowed. Here it is prohibited. See the sequence of the example, you'll see the beauty. A loan payable has got carrying amount 100. The repayment has got no tax consequences. When you will make a principal repayment, tax authorities will not give you a deduction for the principal repayment of the loan. So deduction will not be allowed. So tax base and the carrying amount is same. Why? No consequences. Already allowed, prohibited, and no tax consequences. Three reasons where deductions will not be allowed. Let's complete the list of examples here. Let's come back and fit it out here. So in this particular case, I can fit in two examples have already fit in. So I just need to put in three examples, 2, 3, and 4. So I'm looking at, first of all, a case of, let's say, fines and penalties. So I'm looking at fines and penalties. Are you going to settle in cash? Yes. Will the income tax authority give you a deduction? No. Because it is prohibited. Because it is prohibited. So the tax base and the carrying amount is same. Already tax, already allowed, done. Prohibited, done. Next, we're given, let's say, a loan payable. We're given a loans payable. Are you going to settle in cash? Yes. Will the deduction be allowed? No. It has got no tax consequences. It has got no tax consequences. So carrying amount and the tax base is same. Simple. You can see 4 examples so far. Deduction will be allowed. Carrying amount minus future deduction, tax base. Deductions will not be allowed for 3 reasons. Already allowed, prohibited, not allowed, and no tax consequences. So the only liability left over is the one which is not going to be settled in cash, which is going to be settled by way of goods and service. Let's now come back to the definition. Let's come back to the second part of the definition of a tax base of a liability. So I'm going to now look at the second definition of a tax base of a liability. Watch this carefully. In case of revenue received in advance, if you receive a revenue in advance, are you going to settle in cash? No. You're going to settle by way of goods and service. The tax base is the carrying amount less any amount of revenue that will not be taxable in the future. A little complicated definition. It says it is the carrying amount minus the revenue which will not be taxed in the future. I want you to understand this conceptually. Let's understand this. So I'm just going to put this first of all with an example, then I'll give you some more inputs on this. So there is income received in advance. There is income received in advance. Are you going to settle this in cash? Are you going to settle this in cash? That's the first question you need to put across, because there are two definitions. So you need to first of all zero down that are you going to apply the definition of settlement in cash or settlement by way of goods and service? So are you going to settle in cash? No. The mode of payment, the mode of settlement is by way of goods and service. You're going to see, when you start doing financial instrument standard as well, you will get the flair. The mode of payment is the most important aspect in terms of deciding certain things. And here also, you can see it's very important. The definition will depend upon what is the mode of settlement. In the mode of settlement, because this is one focus people tend to forget when they calculate a tax base of a liability, that the mode of payment is important. If you say the mode of payment is cash, you accordingly apply carrying amount minus future deduction. If you say the mode of payment is goods and services, then a new definition applies. And what is the new definition? So I don't need to put across this question. I will only now calculate that the tax base is the carrying amount minus the revenue, which is not taxable in future. So we will consider in this particular case the carrying amount minus the revenue. Let me just compute it, then I'll give you a logic. The carrying amount is 100. There is an income received in advance. And the income tax authority says, we're going to tax it right now, boss. We're going to tax it right now on a cash basis. So what is the revenue which will not be taxable in the future? Entire 100. They've already taxed you on a cash basis. So what is the revenue on which there will be no tax in the future? Entire 100. So that means the tax base becomes nil. Let me elaborate this further. Let me just elaborate this further. Let's, I think, give you some more inputs on this. This is accounts and this is tax. Let's understand the logic with an income statement approach, and then we can look at the balance sheet approach also. There is an income which is received in advance. There is an income which is received in advance. It is taken in accounts and it is taken in tax, let's say in the same way. I know we don't consider advance income in accounts in the same year. Let's assume. So let's say you took it in both the books simultaneously. Is there a difference? No difference. Do you think deferred tax consequences would arise? No. Because it is taken in the same year. Now consider that there is income received in advance. It is not taken in accounts, but it is taken in tax this year. But it will be taken in accounts in another year. So it's going to be taken in different years. The tax authority took it right now, and the accounting people will take it in the next year. So will a difference arise this year? Yes. Will it give rise to a deferred tax? Yes. Now, in this example, let's apply the balance sheet approach. Let's apply a balance sheet approach to understand this part. Let's apply a balance sheet approach in this particular part. If the accounts and the tax authorities took it in the same year. Now, as per the tax base balance sheet approach, what is the tax base? It is the carrying amount minus the revenue not taxable in the future. Revenue has already been taxed, so the entire revenue, there will be no tax in the future. So what is the amount of revenue on which there will be no tax in the future? The amount is nil. Even this item would be appearing in the balance sheet? No. If you have treated the income received in advance as an income, it doesn't even appear in the balance sheet. So even the carrying amount of this item is going to be zero. Because if you're treating the income in advance in the same year, it doesn't appear in the balance sheet. Now let's again apply a balance sheet approach out here. Let's look at the tax base. So we can say it is the carrying amount minus the income on which there will be no tax in the future. So what is the income on which there will be no tax in the future? So this becomes nil. But if you have not taken this in accounts, your carrying amount in the balance sheet is appearing as 100, as a liability. So the liability is appearing, the carrying amount is 100, the tax base is nil. There is a difference. So you can see that if no differences will arise, the carrying amount and the tax base will always be equal. If a difference arises, the carrying amount and the tax base will definitely be different. Anytime you're stuck up, just apply the income statement approach. Just see that is it taken in the same years? No consequences. Is it taken in different years? There will be tax consequences. I guess, friends, I am pretty clear so far. Let me see if there are any questions coming so far. Okay, that's right. I think that's wonderful indeed. So I guess if I ask you, what is your comfort zone on a scale of 10, what do you think is the comfort zone on a scale of 10 on the step number 2? Because we're done with the tax base of an asset. We're done with the tax base of a liability. My step number 2 gets done. Testing time. It's testing time. In between, let's get your scores. And now it is a little testing time. I'm going to put across a question to you, which many people tend to give a wrong answer. So based on the understanding of the tax base of an asset and liability, let's give you a small little test. And let's see how do you apply the concept. Let's say I've got a trade receivables. The trade receivable is 1,000 minus 150. This is gross receivable. And this is provision for doubtful debts. The carrying amount of the trade receivable in the balance sheet is appearing at 850. So this is undoubtedly your carrying amount. I'm wanting to calculate a tax base of this item. I think let's get your answers on that. So I'm wanting to calculate a tax base of the trade receivable given the inputs that the carrying amount is 850. Okay, I think I got the input 7.5 out of 10 for Shriram. Great. Okay, I didn't get much scores on that. It's very difficult to make a self-assessment. But anyway, I think one score could still be a representative. So now decide that a trade receivable is 850. And this is based on a gross figure minus a provision for doubtful debts. So give me what is the tax base of this item, account receivable. Apply your definitions. Maybe we can give this to you as a homework. You want, I can give you the answer on Sunday. Or if you want, I'll give the answer right away. Okay, I think it'll take some time. Sometimes the answers are coming in a little slow. So I think let me answer this. I don't want to keep it pending for long. So let me, I think, answer this right away to you. There is a huge misconception, which people have got, that when they're applying the definition of to debtors, they look at only tax base of an asset. Now, what do you need to do carefully? To this particular component, you need to apply the definition of asset. And to this particular component, you need to apply the definition of liability. I know provision for doubtful debts is not a liability. It is a provision against an asset, but it's called credit balance. It is to be treated as a liability in order to calculate a tax base for this standard. So in this particular case, you can say this amount will be treated, this component will be treated as an asset, and this component will be treated as a liability. A very good practical example. So now let's put across a question to myself. As far as asset is concerned, I'm going to put across a question that when the economic benefits will arise, will the income tax authorities come or will they not come? When you made a credit sale, they already taxed you. So when you go to collect this money, they will not tax you. So they will not come. So if they will not come, that means the carrying amount and the tax base is equal. Now let's go to the provision for doubtful debts and apply a liability definition. Will the income tax authority give me a deduction when it becomes a bad debt? Will they give me a deduction when it's going to be a bad debt? I say, yes, they will give me a future deduction once it becomes a bad debt. So once it becomes a bad debt, they will give me a deduction. I'll say, okay, then let me consider my tax base is the carrying amount minus the future deduction, the carrying amount minus the future deduction, and this is going to be 0. So we get a tax base for each component separately. So we will say that the tax base in this case is 1000 for the first component, 0 for the second component. So the tax base is 1000. And even if I'm not able to think on these lines, you can apply the shortcut technique of the income statement approach and apply a logic. This is accounts and this is tax. This 150 provision must have been taken in accounting, but it was not allowed in the same year. It will be allowed in a different year when it becomes a bad debt. You're taking in one books in this year, but you're going to take it in the another books in a different year. So will there be a difference? Yes, a difference will arise, and therefore deferred tax should arise. And if a deferred tax should arise, I know that the carrying amount and tax base in any case cannot be same. I can apply logic as well that in this case, since the provision for doubtful debts is taken in 2 different years in the 2 set of books, the deferred tax consequences would arise. The carrying amount and the tax base certainly is going to be different. I guess you got your answers on that. Okay, so far, so good. And the question you said, in case of income received in advance, the carrying amount is, in my example, it is 0. Because I'm considering that income received was taxed on a cash basis in income tax. So the revenue is not going to be taxable in the future. So if you go with the logic that income received in advance is going to be taxed on an accrual basis, then the carrying amount and the tax base will become equal. So in our example, we presumed that it is taxable on a cash basis. So tax base will become 0. Okay, so this part is done. The tax base of the asset, the tax base of the liability is done. Now, a caution, friends, at this stage. I'm talking of step number 2 and a small caution at this stage. When you calculate a tax base, in step number 1, we said calculate a carrying amount of every asset and liability. Can there be items which are not in the balance sheet? but they have a tax base because there are items in the balance sheet for which a carrying amount is given, and you're calculating a tax base. But can there be situations when the carrying amount is not in the balance sheet, but it does have a tax base? Yes. The standard gives you another caution area, and that is given out here. Let me just read the input stream. Sometimes items have a tax base, but they're not recognized as assets and liability in the balance sheet. They're not appearing in the balance sheet of the company. The carrying amount is not there. Example, if you look at Index 38, if a company incurs a preliminary expense, it is allowed as a deduction 100% in the year in which it is incurred. But under the income tax provisions, if my provision section is correct, I think section 35B of the Income Tax Act allows you a deduction 1/5 each year. So if you incurred, let's say 10 lakhs, accounting, you took it in the same year. Taxation, you took 2 lakhs in this year, and the remaining 8 lakhs will be taken in the future year. So the carrying amount is not in the balance sheet. So you can say the carrying amount of the preliminary expense in the balance sheet is nil. But if you look at the tax base of the preliminary expense, if you look at the tax base, so I will say, okay, when the preliminary expenses have been incurred, will they give me economic benefits? You're incurring a formation expense to the company with the thoughts that yes, economic benefits will arise. You created a company, and when you created a company, the benefits will arise by way of sale of goods and services. Will it be taxable? Yes. Will the income tax authority give me a deduction of the preliminary expense? So in my example, if out of 10 lakhs, 2 lakhs has already been allowed, so what is the future deduction to be allowed is 8 lakh against the economic benefits. So in this case, the carrying amount is less than the tax base. This will become a deductible temporary difference of 8 lakh. And this is going to create a DTA. Let's say the tax is 40%, it becomes 3.2. So let me, I think, put this once again to you very clear. In terms of preliminary expenses, for example, you made a payment and it was fully taken as an expense in accounting. The carrying amount is zero. Income tax authorities gave you a 1/5 deduction, let's say 2 lakhs out of 10 lakh, 8 lakh will be allowed in the future. So when the preliminary expenses were incurred, they were formation expense of the company that yes, we're going to generate revenue. Will the income tax authorities tax that revenue? Yes. Will they give you a deduction against that revenue for the preliminary expense? Yes, 8 lakh. The carrying amount is 0. The tax base is 8. When the carrying amount is more, it's taxable. When the carrying amount is less, it is deductible. See what it says. For example, preliminary expenses are recognized as an expense in determining accounting profit in the period in which they are incurred, but they may not be permitted as a deduction in determining the taxable profit until a later period. The difference between the tax base being the amount permitted as a deduction in future under the tax laws and the carrying amount is nil is a deductible temporary differences that results in a DTA. That's what I give you. So you can see that we need to be careful in a practical life situation that there could be certain assets and liability which have got a zero carrying amount. But still we need to identify that if this item has got a tax base and accordingly you apply the deferred tax consequence. Okay, so this was one part done. Now friends, I'm going to the crucial part of the standard. That is my step number 3. I'm taking you to a very crucial part of the standard, and that is step number 3. Sorry. Now please hear my thoughts very carefully, because the next 10-15 minutes is going to be very crucial, and that will develop my base for the coming portion of the standard. Very crucial indeed. If you get this chain, we are done for step 3. Step 4 is not a challenge. Step 5 is not a challenge, because that is simply applying a tax rate and just deciding, whether you're going to take it in the P&L, OC, or whatever. But step 3 is not going to take a good time, and let's get the chain very clear. So I'm just going to take you to a little inputs which is given in the standard, and we're just going to read a few things with you. You're just going to read a few things with you. So I've taken 3 relevant extracts. Rather 2. I've just taken 2 relevant extracts from the standard to give you a complete picture of things. Now please have a look at this very carefully. This is going to build your concept, and this is going to be, our step number 3 now. Okay, let's have a look now. Taxable temporary differences. I'm looking at taxable temporary difference. Now, let me caution. When does a taxable temporary difference arise for asset? When the carrying amount is more than the tax base. When does a taxable difference arise for a liability? When the carrying amount is less than the tax base. Liability, asset ka ulta. So when does a taxable difference arise for asset? When the carrying amount is more. When does it arise for a liability? When the carrying amount is less. Simple. A deferred tax liability shall be recognized for all taxable differences except. Now, I'm not reading further, but please hear me carefully. There are a total of 2 exceptions when a taxable temporary difference is there, but still we don't recognize a DTL. I repeat, the standard says that you need to recognize a deferred tax for all taxable differences except to the extent. So they have given us a total of 2 exceptions where they say prohibition. You cannot create a DTL. So the exceptions are, one regarding the initial recognition of goodwill, and one is regarding initial recognition of asset and liability, which fulfills certain parameters. Let's not get into those parameters right now. But you need to get one thing very clear, that once you say there is a taxable temporary difference, I will say, okay, let me check. Is it a case of 2 exceptions? If yes, please don't create a DTL. Next. However, for taxable temporary differences associated with investments in subsidiary branch associate, a DTL shall be recognized in accordance with para number 39. This is not an exception, but this is an assessment. Get this very clear. There are basically, you can say, 3 categories of DTL. Now hear this very carefully. Please hear every word on a very careful note. If you get a taxable temporary differences, there are 2 exceptions. There are 2 exceptions when a DTL cannot be created. There are 2 exceptions where the standard prohibits you cannot create a DTL. There is one case which needs an assessment. It may be created, it may not be created. So there are 2 exceptions. आप create कर ही नहीं सकते. And there is one case where you need to assess, हो सकता है मैं DTL बनाऊं, हो सकता है मैं DTL ना बनाऊं. So this is a case where it may or may not be created. You need an assessment, and rest all the cases you will recognize a DTL without any ifs and buts. So we can say that when you get a taxable temporary difference, you need to see, is it falling in the 2 exceptions? Don't create DTL. Is it a case of investments? I need to make an assessment. I will decide whether a DTL should be created or not. If it is not a case of exception, if it is not a case of assessment, rest all the cases, a DTL will be created without any ifs and buts. So we need to understand the exceptions and we need to understand the assessment case, right? I guess my chain is very clear. I guess my chain is very clear at this stage. Let's take it further. Now I am coming to the next area, that is deductible temporary differences. Don't worry, I'm going to give you a chart very soon on this basis. I'm now looking at deductible temporary differences. When do you get a deductible temporary differences for an asset? When the carrying amount is less than the tax base. And when do you get a deductible difference for a liability? When it is the reverse here, the carrying amount is more than the tax base. So a deductible temporary differences for asset will arise when the carrying amount is less. For a liability will arise when the carrying amount is more. Now let's see. A deferred tax asset shall be recognized for all deductible differences to the extent it is probable that taxable profits will be available. To create a DTA, there is a precondition. To the extent it is probable, I call it as a COP, not a certificate of practice, but I call it as a concept of prudence. If there is a deductible temporary differences, you need to create a DTA only and only if you can prove that taxable income will arise in the future. It's a similar concept what you have done in terms of IGAP AS22 when you're looking at that future taxable income should arise, and you did the concept of reasonable and virtual certainty. Well, there is no concept of reasonable and virtual certainty in terms of Ind AS 12. There is only reasonable certainty. So if you want to create a DTA, they're asking you that you prove me the concept of prudence. The concept of prudence means prove it to me that a future taxable income will arise. We will be discussing this concept of prudence, and I'll give you a step-by-step approach on this case as well. I'm going to give you a 3-step approach on prudence later. So we'll see how does a prudence assessment require, because there are some questions in the study material and which have come in the exams where the prudence is to be tested. And there is a 3-step model which we will cover on the prudence. That is a separate discussion. Then he says, unless, now there is an exception, unless the deferred tax arises, and there is only one exception. In terms of DTL, there were 2 exceptions. In terms of DTA, there is only one exception. So one exception with the standard prohibits the creation of a DTA. Then he says, however, for deductible temporary differences associated with investments in subsidy branch associate, a DTA shall be recognized in accordance with para number 44. There is one case of assessment. So if you technically ask me, I would say in terms of a DTA, there are again 3 categories of questions. There are again 3 categories of questions. You wonder, every time, sir, you create a 3-step model, you've got 3 inputs, everywhere you keep talking in terms of 3, I mean, that's just chance. So I would say there is one exception. There is one exception where the standard says you are prohibited from creating a DTA. I would say there is one case which requires an assessment where I will say a DTA may or may not be created. And then I will say there are rest of the cases, and in the rest of the cases, you can create a DTA. You can create a DTA if COP is met. It's a conditional creation. It's a conditional creation. So moral of the story, In terms of DTL, you got three blocks. Don't worry, I'll make the chart right away. In terms of DTL, there are three categories. Two cases, you cannot create a DTL. One case, you need an assessment. And the third case, where you will create a DTL, no ifs and buts. In terms of DTA, one exception, you cannot create a DTA. Second, one case of assessment, you need to decide. And the third case, where you will create a DTA provided the prudence is met. I hope the chain is very, very clear, 100% clear on this. So I'm just going to document this chart to you because this is how we will work upon this. So let me just create the chart to you at this stage. So let me just add on this chart. This is based on the step number 3. So when you're going to look in terms of the step number 3, when you're going to look at this step number 3, we are basically going to compare the carrying amount and the tax base, what you've computed in step number 1, and in terms of the step number 2, mathematical comparison. You will simply compare the carrying amount and the tax base of the asset and liability. Now, in this particular case, there are two permutation combinations. There are two permutation combinations which would arise. Either you get a taxable temporary difference or you get a deductible temporary difference. When you get a taxable temporary differences, you will get a temporary taxable temporary differences in terms of asset when the carrying amount is more than the tax base. In terms of liability, when it is the other way around. These are the only two combinations where a taxable difference could arise with a balance sheet approach. And when you get a deductible differences in terms of asset, when the carrying amount is less, when the carrying amount is less than the tax base, and in terms of liability, when the carrying amount is greater than the tax base. Get this clear that these are the two permutation combinations which could arise in this case. Now, if you get a taxable temporary differences, if you get a taxable or a deductible temporary differences, I would categorize the questions in 3 sections. If you get a deductible temporary differences, I will categorize the discussions in 3 categories of questions. One is, we can say a case of exceptions. When I say exceptions, it means DTL cannot be recognized. The standard prohibits, DTL cannot be recognized. All I'm giving you is that there is a list of 2 exceptions. What are the exceptions? Don't worry, we'll talk about them later. But there are 2 exceptions in this particular case. Next, I need to say that there is one case of assessment. There is one case of assessment, which means DTL may or may not be created. The DTL may or may not be created. So this is, you can say, the other case, assessment. There is only one case of assessment, and let me tell you in advance, it pertains to investments. It pertains to investments. So 2 exceptions where you cannot create a DTL. One case of assessment which may or may not create a DTL. And then we can say that we've got rest of the questions. Create DTL. We create DTL, and I'm saying no ifs and buts. There are no ifs and buts, no preconditions to create. So get this very clear, 2 exceptions, 1 assessment, and rest all the cases, I'm going to recognize a DTL. Okay, now let's come to the other part, and that is deductible. So deductible, again, we've got exceptions. We've got exceptions, and this means DTA cannot be created. DTA cannot be created in this case. The standard prohibits that you're not going to create a DTA in this case, and there is only one exception. Which exception we'll see? We'll see that exception later, that which is the case where a DTA cannot be created in this case. And now let's go to the next one, and that is assessment. And that is assessment. In terms of assessment, DTA may or may not be created. DTA may or may not be created. So DTA may or may not be created. We'll have to make an assessment. And in this case, again, there is only one case, and that, let me tell you, is the case of investment. So the chain has to be very clear in terms of step number 3, that there are 2 exceptions, DTL, 1 assessment, rest created. DTA, 1 exception, 1 assessment, and then we can say in the rest of the cases, we create a DTA subject to COP. We create a DTA, but it is subject to prudence, conditional. You can't say in the rest of the cases, DTA will be created. I'll say I have to make an assessment, and I have to see whether the concept of prudence is getting met or not. So as far as the concept of prudence is concerned, we're going to develop a 3-step model on this. On the concept of prudence, I'm going to work on a 3-step model on this. So moral of the story. In step number 3, I need to teach you the exceptions and assessment. Rest you know. I need to teach you the exceptions and assessments and the concept of prudence. So my focus is now going to be on exceptions, assessment, and prudence. Once that is done, step 3 is done. Once step 3 is done, there's nothing much in terms of step 4 and 5 that we do it very quickly. So the main concentration left over now is in terms of the step number 3 with you. But I hope the chain is very clear. And as I said, that today also I'm taking a little early leave from you because I'm still improving on my throat. It's a much better indeed. But I hope another 1 day of rest, because Sunday we'll meet you at 7 in the morning. We've got 3 hours extra class on Sunday to compensate for the 1.5 hour yesterday and 1.5 hour today. So we're going to carry that 3 hours with you on Sunday, and I'm pretty sure that we will finish good, do the standard with good appropriate details to you. So please revise all this, and I'm sure you will become very confident. And this is in a way, blessing in disguise. That we're building up the concept on a slowly step basis. You got the concept of a tax base. Then you got the chain of the step number 3. Now the complications of the step number 3 can be studied. So it's in a way a blessing in disguise as well. So let me see if you've got any questions, friends, so far. Okay, I think there are no more questions coming in. So I'll be taking a little early leave today again with you, friends. But remember, we're going to see you at Sunday. I'm going to meet you at Sunday. And Sunday, we're going to have a class at 7 a.m. to 10 a.m. And I'm pretty sure I will be able to take a 3 hours class. Things are a little better today, but I'm still not wanting to take chances. So we'll finish up the standard in that case. Thank you, Namrata. Thank you so much. Now, thank you, all of you, friends. So join you back on Sunday morning. Thank you. Bye-bye and take care.